Hi, everyone. I'm Arun Matthew. I'm a partner at Accel. We're happy to be here. We know it's the end of the day, so we'll try and keep this entertaining and lively. Some questions at the end. We were fortunate enough to be the first investor into Drip Capital, and so I've heard this story, but I'm sure you guys are going to enjoy hearing this story too. It's a very authentic story and a pretty exciting company in a really big market. So let's take it away. Neil, give us a little bit of your background, maybe a little bit about yourself and how you initially started, the company.
Sure. Thanks, Arun. And thanks again, everyone, for being here. And thanks to Trusted Insight for organizing all of this. So, a little bit about Drip, and then I can jump into the sort of how we got started. So we're a cross-border trade finance company. We finance the movement of goods from one country to another. And the way we got started, sort of the inspiration behind the idea actually started out when I was a kid growing up in Hong Kong over 30 years ago. And at the time, like many others, our family ran an export business. My father manufactured jackets across the border, leather jackets at a factory in Shenzhen, and sold them to large US brands and retailers like Wilson's and Macy's. And one of the challenges that he ran into, one of the things that kept him up at night was getting paid and the lack of transparency over that entire process. Because once the leather jackets were prepared already in the factory, they'd have to get on the ship. The ship would take 2-3 weeks to get to a US port, sometimes longer if there were delays. After that, the jackets would get on a truck. They'd finally make it into a Macy's warehouse. Macy's at that point would take another 30 or 60 days to make a payment. And during this entire period, he'd be getting orders from other retailers and brands while he'd be waiting to get paid. Now, this was back in 1989 when global trade was at, call it $3 trillion. Today, it trades at almost $20 trillion, but the process and the wait for getting paid hasn't changed. And banks haven't stepped in to fill this working capital gap for small emerging market exporters like my father's. And part of the reason is when you look at sort of cross-border trade finance, the major players are large international banks like HSBC, Standard Chartered, and they have a very sort of manual relationship-based approach that is targeted towards corporations, large exporters. They don't have the technology, the systems, the processes, frankly, the inclination to help finance and service small exporters with a high velocity of small dollar invoices. And so as a result, you have $1 trillion of trade finance applications coming from a long tail of small exporters in emerging markets that are creditworthy that get turned down every single year. That's $1 trillion of trade that should happen, but doesn't. Oops. And so this is a problem that we've set out to solve. Our mission is to help the long tail of emerging market exporters, small business exporters, get access to working capital and level the playing field for them. That is to help the millions of small exporters that are in Tier 3 and Tier 4 cities in India and China and Vietnam and Mexico and Colombia get access to working capital and grow their business.
So maybe give us a sense, Neil, of the current state of the business as it sits today and some of the progress that you've made, over the last few years since you've launched.
Sure. So we started this business, this trade finance business, in late 2016, so almost 3 years ago, my co-founder Pushkar and I. And since then, we financed about $400 million of trade. We've worked with 700 odd exporters and importers that are based in over 50 countries now. We financed about 7,000 invoices, had loss rates on just 25 basis points. And the company now has 120 folks that are spread across 4 offices: Mumbai, Palo Alto, Dubai, and Mexico City. And when we started out, though, in 2016, one of the things when we went through the Y Combinator program, one of the things we learned from Paul Graham was, really focus on a very niche market, a small market where you can really find product market fit and where the customers really love you, and then grow from there. And so the way we actually started was we started off with sort of just the India-US corridor, packaged food exporters, and just that one corridor, Indian exporters selling to the US buyers. And at the time, we were just 2 of us. And then, in 2017, we expanded, but the focus in 2017 was really building out the infrastructure, the risk management, the systems, because as we were building out a lending platform, we had to be very careful about risk management and processes so that when we scale the business, we weren't at risk of making mistakes or losing money. And so a lot of the focus in that year was around underwriting of exporters, underwriting of buyers, building the systems to process invoices, and then building out a very seamless customer experience where basically an exporter could submit a transaction online and get funded instantly. And so in that year, we grew from having one buyer country, which was the US, to 8 buyer countries, and the team grew to 10 people. But those first 10 hires were really critical, and many of those hires came through references from Accel and some of our other really supportive investors. And out of those 10 hires, all of them are still with us, and our first engineer has become the head of engineering for the company. The risk manager that joined us that year now runs risk management for the entire company. But again, I think the focus in that year was, again, building out infrastructure so that we could scale the business. And then in 2018, we started to scale up. We went from 8 buyer countries to over 40 buyer countries. We went from 10 to 100 people that year. We financed $200 million, and that was about 3,000 invoices, and we didn't have a single charge-off or a single non-performing asset over that entire year. But I would say more importantly was kind of the impact that we saw that we were having with our small business customers. On average, our customers have grown with us, grown because of us, 20% year on year. That's 20% more revenue that they've had. 60% of our small business exporter customers are based in really small tier 3 and tier 4 towns. And that's 3/4 of those customers are using trade finance for the first time because of us. And so it's sort of really gratifying to see the impact that we've been having with some of these customers over the last couple of years.
Neil, one of the operative questions that we spend a lot of time talking about as a management team and as a board is how to manage risk. Because on one hand, we want to extend the impact and the footprint that we have and obviously grow and build a great business. But on the other hand, we can't get ahead over our skis. And so how do you think about, and how should the audience think about this class of trade finance and balancing risk? And maybe talk a little bit about how we think about risk and managing risk operationally.
Sure. So prior to co-founding Drip, I was a fixed income trader at 2 sort of very large institutions, Blackrock and Goldman Sachs. And one of the challenges that we ran into, which I think most, if not all of you could relate to, was generating alpha. And as a result, what we ended up resorting to was taking on just large macro bets or taking on macro risks. For example, we would go out the yield curve, sometimes 5-10 years, and take on significant interest rate or duration risk. And so when we launched this business, I was personally really excited about the prospect of sort of trade receivables as an asset class, because here you basically have a very short duration asset, a cash alternative, 35, 40-day duration asset. You have an asset that has been very stable across market cycles, that has limited market risk, and has performed very well. And part of the reason this has been the case is because trade finance inherently is a pretty low risk asset, and the reason for that is when you're financing a transaction, that loan is tied to a very, very specific transaction rather than being lent to a company. that transaction is one that the goods are, you have finished goods, you have a purchase order, you have an invoice, you have proof of shipment. And then the third thing, which is interesting, is you get paid back by the buyer. So the way that we work when we manage risk and the way the cash flow works is that when you have an exporter and they've actually put the goods, or their logistics providers put the goods on the ship, at that point we'll do 30 different checks on every single shipment, everything from fraud checks to foreign buyer credit risk checks to fulfillment risk. And at that point, we'll advance 80% of the value of the invoice. You have an 80% LTV. Call it 60 days later, the buyer will pay us back and pay us back directly. And 80% of our buyers are based in a developed market. So basically, while you're providing capital to an emerging market company, an emerging market exporter, you're taking developed markets credit risk. And as an extra layer of protection, we wrap that credit with a single A insurance wrap from a large trade credit insurer, Allianz. So you're kind of wrapping this with single A credit risk, which makes this a very attractive fixed income investment. The second piece of this, which is very specific to cross-border trade, it doesn't work very much for domestic trade, is that you have third-party agencies. They're involved in every transaction. You have customs departments, you have a tax authority, you have shipping lines, you have inspection agencies. And so each of these different third-party agencies leaves a digital footprint for each transaction. And so what we're able to do is leverage this third-party data, which has now been digitized, and use that to objectively underwrite every single transaction, and to do that in a very automated and scalable way. And so when you combine these things, what you get is you get a very attractive fixed income asset that's a cash alternative, where we get a double-digit yield, for a 35-day duration asset, with loss rates that are in the basis points, with very significant excess spread.
Maybe to sum this all up, give the audience a sense of where you're headed as a company and organization, and what are some of our goals and aspirations that we want to accomplish over the next 3 to 5 years?
Sure. Thanks. So, while we've made some progress over the last 3 years, we've really just scratched the surface for trade finance. The countries where we've been most active and have become sort of amongst the market leaders, the export geographies have been primarily India and Mexico. And then even today, we've financed, call it 1% of the SMB exports coming out of the region, coming out of these two countries. And so there's sort of massive room to grow. Interestingly, though, if you look at India, for example, 150 billion out of the $350 billion of exports come from small and mid-sized businesses. And interestingly, almost 40% of the GDP is driven by small and mid-sized businesses, but they only account for about 18% of the total debt outstanding. So they're significantly undercapitalized. And this isn't a surprise. I think we have a pretty archaic financial system in India, and this is not unique to India, where sort of the allocation of capital can be inefficient and can cause a huge disparity between smaller companies and larger companies' prospects. And when we've looked at other countries, Mexico, Vietnam, Indonesia, and the list goes on, the problem is very similar. And again, even in many of these other geographies, one of the key drivers for economic growth has been sort of small family-owned businesses. And being able to help fund small business exports could have a significant impact on the employment in these countries, on the development in these countries. And of course, most governments recognize this, and both the Indian and Mexico governments have now partnered with us to so that we can help them promote trade, so that we can help fund exports. But when we look out, I think we all know that global trade is obviously very large. It's about $18 trillion, almost $20 trillion a year. But what's not obvious is the actual non-bank institutional investment in the sector is only about 25 to 30 billion. And when you compare that, for example, to the U.S. mortgage bond market, which is $15 trillion, there's just a lot of room to grow. And part of the reason behind this is, again, sort of large banks dominating the sector, large banks involved in not just origination, but keeping the trade finance assets on their balance sheet. And because of their focus on larger exporters, we're seeing a huge trade finance gap. So the $1.6 trillion of trade finance, of the trade finance gap that we see is almost entirely composed of small emerging market businesses. So I think when we look at kind of as a business where we want to be, where we are now, and then sort of like where we want to go. Today we're primarily in India and Mexico in terms of export geographies. By the end of the year, we'll be in 5. The plan is by the end of 2020 to be in a dozen different export geographies. But I would say that the vision for the company is really for no small business, 5-10 years down the road, to have to say no to an order, regardless of where that business is based, whether they're in Sao Paulo or New Delhi or Mexico City, because they don't have the working capital to fulfill that order.
Well, I think that's our time. We appreciate it. Thanks for having us.